Hey, futures traders. This is the start of an educational series on the quant alpha strategy that you see me trade almost daily. So before we get started, this is for educational purposes only. Trading is risky, so please do not trade with money that you can't afford to lose because you will lose money. There will be losses, and you don't want to trade with any money that you can't afford to lose. I'm not a financial advisor either. I'm just a trader like many of you. So I'm just sharing these thoughts with you. And like I said, for educational purposes. So let's start with the quant alpha strategy. And since April 1st, I've been trading it almost every day. There are exceptions where I don't trade. But we've had 4 losing days since April 1st. We had one on April 1st. We had one on April 16th. We had one on April 23rd. And we had one on May 13th. So 3 total losses in April, 1 in May so far. We did have some days where I didn't trade to either Fed speakers, FOMC, or no valid signals. But I typically don't like to trade when the markets are up 3% up or down either. So far so good with the strategy. Now, let's take a look at what is included in the strategy before we get started. Well, here's what comes with Quant Alpha. There are 3 things that come with Quant Alpha. Let's take a look. So when you install it, you'll get 3 components to it. You'll get the Quant Alpha supply and demand, you get a Quant Alpha volume signals, and then you'll get the actual strategy itself, which is it's set up as a strategy. Okay. So the Quant Alpha supply demand zone are these zones here, this red and this greenish bluish color. Okay. So the way these work is these are moving targets. These continue to move. So as we see a high or a low on the 1 minute chart, you'll see these zones adjust accordingly. So if it goes above here, this zone will move up. And it's not meant to be hardcore support and resistance. It's just meant to show you where the highs and lows are of the day. Okay, so you can see we had a low here. We hit it here, so the red stayed there. If we go up, this zone will move up. If we go down, this zone will move down. And those come into play with a specific type of trade that I'll explain to you. Now, some of the other things that are on here are the high volume, okay? And the high volume areas are when you see this green triangle or a red triangle, this will signify that there's a lot of volume associated with this bar. Okay, so this candle here had a lot of buying volume. And likewise, when you see a red one, it will signify this candle had a lot of selling volume. Now, it doesn't mean you place an order right away. It just tells you there was a lot of volume, okay? And of course, the third component is the strategy itself, which will show you a red or a green with a quant long verbiage or a quant short verbiage to let you know, get ready to place a trade, okay? So those are all the components of the strategy that you install. Now, what you then do is you add a couple of the Ninjatrader free indicators. You add the bar timer, your swings, a parabolic SAR, the price line, which you'll see going back and forth with price, the net change, which is this indicator here that shows you how up or down the market is at this moment. You'll throw a couple EMAs on there, an 8 EMA and 100 EMA. You'll put your pivots on there, your prior day open, high, low, close, your current day open, high, low. And these are areas of support and resistance that will help you with your trades. And then your pivots are showing you where your pivots will act as support and resistance as well. So those are all of the elements that you need to have on your chart for the Quant Alpha strategy. The next video I will share with you, or the next section, will be the rules for taking the trade. One other thing is the ATM that comes with it looks like this. Okay, you have 2 mini contracts, and again, you're trading a $250,000 account. You don't want to trade anything less if you're trading 2 minis. You can trade micros on a $50,000 account, and you could use between 3 and 6. So depending on your level of risk, you can also do that. So if you want to trade $50,000 accounts, you trade micros, 3 to 6. If you want to trade your $250,000 account or higher, you trade 2 minis. But the ATM looks like this. You have target 1, target 2. Your initial stop is set to 100 ticks with a profit target of 80 for the first one and a pretty long profit target of 400. Again, you're going to have a trailing stop strategy associated with that. So very rarely will you hit it unless the market is booming. So for the first stop strategy for target 1, it will go at break even when it hits 70 ticks. Okay, so when you hit 70 ticks, you're going to get moved to stop break even plus 1 tick. And again, this ATM is for the open because the opening bars tend to be larger. You can use this ATM. There are going to be different ATMs that I'm testing that will be different. Okay, the custom stop strategy for target 2 looks like this. You have a profit trigger of 80 ticks, 100 ticks, and 200 ticks. This ATM does very well in managing your trailing drawdown. So if a market is moving pretty fast, your step 2 and 3 will keep step right behind the price action. So you're not going to hit a trailing stop. I haven't seen it go that low. It gets right on its tail. As a market gets more aggressive and more volatile, this trailing stop will be right there. It gives you room to breathe on the first couple of steps, step 1 and step 2. But if the market starts to take off on you, step 3 gets right on its tail. And like I said, it very rarely does it hit the 400 tick target, but the ATM will manage it for you. So that is, those are the components that make up Quant Alpha, all the indicators you need to add to your chart, and the ATM. Okay. So with that said, I will now make some videos on the different types of trades. Okay, let's talk about the different types of trades you're going to be able to take with Quant Alpha. So the first type of trade is called an S1. And an S1 is signified by the strategy where it shows you these green areas here, along with the text verbiage quant long or quant short. So when you get this signal, it gives you an indication that you're going to get ready to do something. Okay, so S1 is a 3-step trade. The first is when you get a quant long, you check to see if it closes above the 100 EMA. And this white line on my chart is considered the 100 EMA. So the first thing you look at is, I get a quant long, step 1. Step 2, did it close above the 100 EMA in this case? Yes, it did. Step 3 is, do I have enough room to hit my first target of resistance above? So in this case, do I have enough room above from the high here to the next area here? In this case, you had 33, so the answer would be no. All right, so this would make this an invalid trade. If, for example, you did have enough room, and like I said, the 80 tick target is good for the open. You can trade different targets with a different ATM if you so choose after the open and market settle down. But let's, for argument's sake, say this was a valid trade. It closes above the 100 EMA and you had plenty of room to your target. You would place your order above the high of the signal bar and your stop loss a few ticks below the bar, the signal bar, or keep it at the 100 ticks that the ATM has for you. Now, there are some traders that will take and be more aggressive and that will take it here. That's a lot of ticks. All right, it's a lot of ticks. And again, I can't tell you what to do. It's up to you to manage that risk. So if you want to risk 111 ticks, you can. Okay, you certainly can. it's your call. But the rules should say that you can place your stop loss at the swing low, in this case, here, which would be below the signal par, right? Or if you want to be more aggressive, you could place it right up here. Okay. But the rule says you want to put it either at what the ATM gives you or at, in this case, the low. Okay. So again, recapping, the S1 is a trade that you look for the signal to close above the 100 EMA in this case, that you have enough room to reach your first target without any support or resistance. And again, you can see here's resistance. Okay. And then you place your order above, a few ticks above the high of that bar, of the signal bar. In the case of a quant short, let's look for a valid quant short here. Quant short is just the opposite. You get the quant short signal. You ask yourself the question, does it close below the 100 EMA? Yes, it does. Is there enough room to hit your first target? Let's say you say, yes, there is in this case, as in this example. You place your order at the low of this bar a few ticks, and you put your stop loss above, in this case, the high here, or again, if you want it at the recent swing high, you can also put it here. Again, you're the trader, so you can choose you're managing your own risk, so you can choose to put it here as well. Again, either here or here for your stop loss, your call. And then you let it hit your first target, it moves to break even, and then you let the ATM let it run, or you can trail it manually, or you can let the ATM trail it. So that's considered an S1, okay? Again, pretty simple. You get a quant long or quant short. Does it close? In the case of a quant short, does it close below? Do you have enough room to your next area of resistance of support to hit your target? You do. You place the trade. Quant long, again, you get the signal. Does it close above the 100 EMA? Yes. Do you have enough room to hit your first target? Yes. Place the order. If you don't, invalid trade. Okay? So that's an S1. Okay, the second type of trade is called an S2. And an S2 is pretty simple. They don't happen a lot, but when they do, they're a powerful trade. So an S2 is when you get a quant long or quant short that isn't valid. So it hasn't really met any of the rules. So either in a quant long it hasn't closed above the EMA, or if it has closed above the 100 EMA, you didn't have enough room. So if you don't have enough room to the next area of resistance, then it's considered invalid. So here's a good example. We had a quant long here that closed below the 100 EMA. So what you look for is the first high volume bar that closes above the 100 EMA. So we get this quant long, doesn't close above the EMA, 100 EMA, invalid. So we wait up. We get a high volume indicating signal here. You wait for it to close above the 100 EMA. Okay. Then you also then check to see if you have enough room. Okay. Again, now these areas here are moving with current price action. So this zone wouldn't have been here. So what you do when you get this is you place your order at the high of that bar and you put your stop at the low of that bar. Okay, right here. Now, again, as a trader, you can choose where you put your stop. You can let the ATM stop kick in at the 100 ticks. You can move it at the most recent swing low, or you can put it right below the low, a couple ticks below of that signal bar. Okay, your call. It's a trader. As the trader, you can choose your risk. Okay, so that's an S2. Again, an S2 doesn't happen a lot, but it's always when you have an invalid signal, an S1 signal, you wait for the first high volume bar indicator to show, then you take that trade. So in this case, that's a good example of a long. Let's see if we could find a short. Like I said, they don't happen a lot. Okay. Here's one here. Here's one here that would have executed but been a losing trade. And again, I usually don't do pre-market. It was in the middle of the night, 3:30 in the morning. So let's see if we can find a valid. I may not find one because, like I said, they don't happen a lot. Yeah, here we go. Here's a quant short. It was not valid because it was not closed below the 100 EMA. We had our first bar that closed below, barely below it. You place your order here, your order right here. Place your target, your stop loss right above here. And again, you would have gotten 24 ticks. Again, you could see why this ATM is not meant for anything pre-market. So you're going to want to use a different ATM if you like to trade pre-market of like your first target's 20 ticks rather than 80. So that's an S2. Okay. So here's a good example of live right now. There's a quant short happening. What you would do is if the quant short doesn't close below the 100 EMA, you would look for the first high volume bar that closes below the 100 EMA and make sure you had enough room for the trade. Because it's 1:15 my time, I wouldn't be using this ATM. I'd be using the ATM that's about a 20 tick target for the first target. So that's S2. Like I said, very simple. Still follows the same 3-step process. You wait for the signal, make sure it closes above or below the 100 EMA, depending on the direction. Make sure you have enough room of either support or resistance out of your way, and then you take the trade. Okay, we'll move on to the S3. Okay, let's talk about the last trade type. Last trade type is an S3, and in essence, an S3 is a breakout. Okay. So what you look for in an S3, and this happens almost every day, every morning, quickly. What an S3 is, you look at these zones here that get drawn. And if you have either a quant long or a quant short or a high volume signal, which is basically one of these green or red triangles like this, okay, you place your order above the zone. Okay. Now, let's look at the buy here. So let's say we got this, we were here. Okay. We were here at the open. Okay. We wouldn't have enough room to hit our first target because this is only like 30 ticks from the high to this area of resistance here. However, this would be a valid S3. And what you would do is you would place your order above this zone by a few ticks. Okay. As long as you had enough room to the next area of resistance here, in this case, we would have, and you would wait for it to execute. Okay. In this case, we had a strong volume. We had a quant long that was not valid because we didn't have enough room to this area of resistance. So we place our order above the zone. Okay. And again, the mornings are a lot simpler. So let's just take a look at something at the open. So let's look at 9:30. See if we had a signal there. I think we had it. That's where I took mine earlier. 9:30 was about right. Yeah, here it is. Oh, yep, 9:30. There it is. Here's the opening bar. Right at the opening bar, the zone, if I recall, because again these zones move based on the current price action. The zone was right around here, if I recall properly. But anyway, just so you get an example of an S3. So it was here, we had a quant long, right, which I didn't take because it was right at the open. We came down, and then we had this high volume right here. So what an S3 tells you is you place your order right above here, okay? And again, you can either place your stop below the low here, or you can let the ATM manager stop at 100 ticks, and then you wait for it to execute. So you can see we got in around here, and it actually did go up pretty far, 179 ticks, okay? I got it to about 544 until I trailed out, okay? So that's an S3. You wait for it to break out, and you go from there. Okay. Hopefully, this series has helped you. We'll continue to have educational series and hopefully a trade room soon. Thanks. Thanks for watching.